Over the course of the last decade, we've had two uh, particularly strong motivating factors when we're looking at mergers. In the first case, economists have developed a genuine consensus that we've arguably been too soft in the way we're looking at mergers and we should take a harder line, possibly risking the fact that certain mergers should be blocked. On the other hand, we've had the general view that after the financial crisis of 2007, 2008, economies are picking up and merger control is a much more buoyant practice. So where does that leave us in the light of COVID-19? It leaves us in a very difficult situation because, first and foremost, our factual reference points are all no longer reliable. We rely on historical evidence to develop an understanding of a case, and we have to develop a counterfactual to understand what the merger would look like in the absence, what the economy would look like in the absence of the merger. Both of those two issues are now very much up in the air. We cannot guarantee what level of demands there are going forward, at least in the short term. We cannot guarantee that the same costs will be used to drive businesses. We cannot be certain that short-term retail prices that we're seeing, particularly over the last 6 months and going forward, are going to be the necessary result of a short-term blip or a longer-term economic shift. We're not going to be certain that shifts in economies of scale and scope are also not going to be permanent or something which is just short-term. And last but not least, we won't be able to value targets and thereby will not be able to be certain about divestiture remedies and how viable they are. The second point where we're challenged is on the analytical focal points in merger analysis. And I'm not talking about unilateral effects, conglomerate effects, and so forth. We understand and have a general consensus on those. But it's going to be on much more fundamental economic tools like the traditional focus which is developed on profitability. Is that still viable short term? Is guppy analysis to determine price rises very as real and as probative as many regulators have thought that it is in the near past? Will we benefit from shock analysis and natural experiments through the greater use of the internet and so forth? I would hope so. I would think that that's a positive development from COVID-19. When we're thinking about formulating remedies, are we going to have to take into account the fact that there might be very, very significant differences geographically in the way the remedies will operate, given that different markets are opening and closing at different times and at different rates? Is there going to be a greater incidence of monopsony buyer power, which will result from COVID-19? Will there be greater use of bidding market data in areas where we're not used to that bidding data being generated? And last but not, and definitely not least, I think it's the most important issue, will we need to change the level of analysis that we usually do, which is a more or less narrowly focused consumer welfare analysis, and replace that by a more total welfare analysis, one which is based on a lot of other societal goals, like environmental, like employment, and so forth? And secondly, in conducting that analysis, will we have greater emphasis on efficiencies and a greater willingness to learn that efficiencies can be proven, as opposed to just paying lip service to them? The third point, which we have to bear in mind, is I think there's a case for saying that we need greater flexibility in terms of remedies, not just same old business as usual. And I might diverge from a number of the experts that you'll hear from in saying that I think there should now be a greater experimental emphasis on behavioral remedies. I think there should be competition authorities should be willing to explore with national regulatory authorities how they can work together in regulated network sectors to implement those behavioral remedies. I also think that we should stop seeing remedies as a one-shot game. We should throw out a carrot and stick approach, very similar to the regulatory world, whereby we go for tougher remedies up front, but which can be peeled back with some degree of certainty when markets improve and parties have an incentive to get it right. I think by emphasizing a lot more on behavioral remedies in this way, we can overcome many of the concerns that we have with fixing it first, as it were, in a remedy, which is exceedingly difficult to do in a marketplace which you don't know the parameters of, and you don't know exactly how it's going to behave in the immediate future. And also, behavioral remedies are much easier to coordinate when they apply somewhat differently across different geographies. And last but not least, we need to focus on greater procedural flexibility for parties. If it's a relatively straightforward deal, regulators should be able to waive standstill obligations much more readily than they have in the past, with far less red tape. We should also take on board the creation of streamlined procedures for remedy removal. Now, last and definitely not least, we need to take on board the failing firm defense. This has been a topic of some discussion, and the general consensus is the failing firm defense is what it is, and it's not going to change just because of COVID. But is that the be all and end all of the story? I think not. Let's look at the three criteria that we use around the world for the failing firm defense. First of all, the failing firm, in order to rely on the defense, we need to prove that the failing firm is going to exit the market relatively soon. And we have to elicit evidence to that effect as defense counsel. Secondly, we have to prove that there's no less anti-competitive scenario than the merger itself, that there's proof again that alternative options have been sought. And last and definitely not least, that if the failing firm defense isn't accepted, it'll be clear that the assets would exit the market and there will be a net societal loss. Now, all these things are not easy to prove, and all the onus of proving all these factors rests on the notifying parties. The reference points we have in Europe are the Calais Salts case and the Aegean Olympic Airways case. What I'd like to say, though, is that despite the fact that in 2007, 2008, there was a reluctance to expand the defense when the financial crisis hit in Europe, nevertheless, certain doctrines have developed over the years, which means that it's not a be-all and end-all. So what are the alternatives? First and foremost, we can conduct a counterfactual analysis, as occurred in BASF. In doing so, we ask ourselves, would the marketplace be any worse off with or without the merger? Secondly, we can look at the so-called failed division analysis and determine whether or not it's a division of the company which can be peeled off and analyzed as a failing firm in and of its own right, even though the firm overall might be well and truly solvent. Thirdly, we have a precedent in the News Corp Telepew case that even a duopoly to monopoly might be capable of being approved in a failing firm-like scenario if a behavioral remedy can be imposed, which can exercise an ongoing competitive constraint. And lastly, but definitely something which has arisen quite recently in the KLM Martinair cases and the T-Mobile Tele2 Netherlands cases, is what I call the flailing firm defense, which is basically an analysis of whether or not the merged entity would be in a position to continue to sustain significant investments going forward, absent the venture. So yes, indeed, the failing firm defense is difficult to prove, but there is more than one way to skin a cat. Thank you.